West Asia conflict. There has been a sharp decline in equity valuation in India since the war in West Asia started at the end of last month. The benchmark BSE Sensex's trailing 12-month price-to-earnings PE multiple on Friday declined to over a year's low of 20.2 times. This is the lowest trailing PE for the benchmark index since May 2020, when the multiple had dropped to 19.56 times. For comparison, the benchmark index was trading at a trailing PE of 22.3 times at the end of February and 23.5 times at the end of December. The index itself is down 9.5% since the end of February and is lower by 13.7% since the start of this calendar year. The current valuation is just a notch above its 30-year median earnings multiple of 19.9 times. Historically, during a difficult situation such as the pandemic or the euro crisis of 2011-13, the earnings multiple has always fallen below the median value due to a sell-off by foreign portfolio investors, FPIs. For example, the Sensex's trailing PE had fallen to a low of 16.4 times during the 2012 crisis, from a pre-crisis high of 23 times. During the pandemic, Sensex valuation had shrunk to 18.8 times from a pre-pandemic high of around 28 times. Foreign portfolio investors have sold equities worth a record $42 billion since the peak of September 2024, which strongly ties in with India's earnings down cycle around the same time, according to data from Goldman Sachs. Analysts see more downside risks for equity valuation in India, given the likelihood of a decline in corporate earnings and overall economic growth, owing to higher prices of energy and fertilizers and a decline in the availability of both these commodities. The Sensex trailing PE is likely to fall further to around 18 times as equity prices adjust to a potential decline in growth and corporate earnings in forthcoming quarters. This will keep equity prices under pressure as investors sell risk assets and move to safer havens, said Dhananjay Sinha, co-head, Research and Equity Strategy, Systematics Institutional Equity. Even prior to this conflict, India's equity markets were struggling with poor growth in corporate earnings. The index underlying earnings per share, EPS, is up just 1.4% year-on-year in the past 12 months, its weakest growth rate in the past 5 years. The index EPS is currently at 3,639, up from around 3,589 at the end of April last year. This index tracks the combined net profits of the 30 companies that are part of the Sensex. The current energy shock may put further pressure on corporate earnings and, by corollary, on stock prices. A 50% increase in crude oil prices could lift costs of raw materials by around 25%. As a result, the margins for non-financial companies might decline from the current levels of around 16% of net sales to around 10% or even lower, risking an outright earnings contraction, said Sinha. For comparison, the core operating margins, excluding other income, of companies other than banks, finance, and insurance, BFSI, have ranged from 12.4% to 17.6% in the last 5 years. According to analysts, the BFSI sector, which accounts for nearly 40% of the Indian equity market, faces an earnings downgrade from a slowdown in credit growth and an incremental rise in bad loans, as higher energy prices weaken corporate finances and household budgets. We anticipate significant cuts to India consensus earnings forecasts over the next 2 to 3 quarters. We lower our earnings growth forecast materially for India over the next 2 years to 8% and 13% respectively for CY26 and CY27, against pre-Iran conflict estimates of 16% and 14% respectively, wrote Amrita Goel, Sunil Koul, and Timothy Moe of Goldman Sachs in the latest strategy report on Indian equity. Equity prices are likely to remain under pressure from a worsening of India's macroeconomic mix from energy prices staying higher for longer. Our economists have lowered India's 2026 GDP, gross domestic product growth, by 1.1 percentage point to 5.9%, raised CPI, Consumer Price Index forecast by 70 basis points, widened current account deficit to 2% of GDP, weakened INR, and added 50 basis points rate hikes by the central bank in 2026, wrote analysts at Goldman Sachs. Analysts say this will translate into weak inflows of FPIs and lower global risk appetite, translating into lower equity valuation. West Asia conflict. There has been a sharp decline in equity valuation in India since the war in West Asia started at the end of last month. The benchmark BSE Sensex's trailing 12-month price-to-earnings